Street witnessed history in the ETF space last year. According to ETF GI, investors poured more than $1 trillion into U.S.-based ETFs for the first time ever. Additionally, assets in U.S. ETFs grew by more than 30% last year, topping $10 trillion for the first time in 2024. Joining me now with more, Cinthia Murphy. She's an investment strategist at Vetify. Cinthia, it's great to have you on the show as we kick off 2025. And do you see this momentum from 2024 continuing into this new year?
Hi, Kristen. Happy New Year. It's been an exciting time to be in the ETF space because, as you noted, it's been a time of records. And I think, what the flows we saw last year, the record-breaking flows, the record-breaking total assets, is just a trend that we don't see stopping because ETFs have proven their weight in terms of solving portfolio problems at a time when investors are trying to figure out where to allocate. The easy way to implement them, their low cost, their tax efficiency, all the things that make ETFs what they are, has really proven their value. And so I don't see any reason why we shouldn't continue to see adoption grow.
We've seen a little bit of choppiness of late after what's been an incredible two-year run in this bull market. In fact, the best two-year stretch for the S&P 500 since the late 1990s. Does the recent choppiness change your outlook at all when it comes to the broader market?
I think 2025 is promising to be a year of uncertainties. I mean, we have so much going on. Not only we have a new incoming administration, we have a rate outlook that has changed dramatically over the last 3 months. We went from expecting a lot of rate cuts to now 1 or 2 in 2025. We have inflation that has been stickier than most people expected. We have so much geopolitical risk around the globe. So there's so much uncertainty in the market, and it's a market that has been running so much in the last couple of years, as you noted, that it feels like it's really a great time for managing risk. And so I think that choppiness is just going to lend itself to different portfolio allocations that try to, manage that risk that we see in markets today.
What is the best way for our viewers to approach this ETF space when they are looking at their portfolios in this new year?
The good news, Kristen, is that there's so many solutions for any problem you are looking to solve. Well, if we look just at where investors have put money to work in this first week of the year, we're only on day 3. We've seen money start going into strategies on the equity space, for example, that favor more value stocks, that favor smaller cap stocks, favor these parts of the market that have been, overlooked a lot as we just focus like crazy on technology and NVIDIA and growth. We've seen a little bit of a shift. I mean, it's only day 3, but those are some of the trends we're looking for people to try to manage that risk. We're seeing, appetite for equally weighted portfolios. So you manage some of that valuation risk within your equity sleeve. So some of the traditional ways to look at risk management have really stood out already and only in 3 days in 2025.
And do you expect those themes to continue throughout the year?
I do. I mean, I think, for example, if you think about just the small cap space, which is one a lot of market experts are excited about, I mean, there are some headwinds there. I mean, small caps are really susceptible to the rate environment because, they need that borrowing cost to come down. However, there's a lot of opportunity here for really good active managers to show their value in the space. There's a lot of interesting firms doing a lot of interesting things in the space, like, Avantis for American Century. We have T. Rowe Price. There's a lot of interesting firms with interesting strategies, finding opportunities in the small cap space. The same thing with value. It isn't just a game about buying the cheapest stocks. It's buying the quality stocks within the valuation spectrum. So there's a lot of opportunity here for active management in this space. And I think we're going to see those types of funds stand out this year.
Interesting. And Cinthia, when it comes to the new administration, January 20th will mark a turning of the page. And many have said that some transitioning in portfolio picks, with small caps now perhaps back in favor after lagging for a few years, that we could see a changing of the tide. How much does the new administration, have to do with your outlook?
I think if we just look at historical performance, if we look at last time Trump won 2016, some of the parts of the market that worked well, things like financials, industrials, these are some of the sector picks that are also included in value portfolios, that are also leading small cap portfolios. So there's an alignment there. I think the key difference is that the rate environment was very different back in 2016 than it is today. We had the 10-year yield well below 2% back then when he took office last time. We have it well above 4% this time around. And the rates have been a key driver of performance. So I think it'll be interesting to see how, policy changes, tariffs, taxes, all these things that are on the table right now will impact the market. But I think that the interest rate policy will remain key to what drives markets going forward.
Cinthia Murphy, thank you so much for joining us as we kick off this new year. Cynthia is an investment strategist at Vetify.
Thank you, Kristen.